All right, so we're going to continue our conversation about the Great Depression, and we're going to go from this current slide as promised. Right, talking about on margin buying. So everybody talks about the idea that the stock market crashed, and this is, the big opening moment of the Great Depression. And I want to make sure that you understand the stock market piece of it. It's complicated. There are whole economics books about this and lots of theories and lots of ideas, but there's general agreement on one basic fact of it, is this idea that there was a thing called on margin buying. And this is a real factor in the crash of the stock market. And this is just one piece of the puzzle. But basically what on margin buying is borrowing money to buy stock. So let's say, we'll see how I can make this work. You won't laugh at me too hard, right? Let's say I want to buy some stock for $100, right? And I'm doing this on my little tracker pad, so don't laugh too hard. I want to buy some stock for $100, but I don't have $100. I have $10, right? So I have $10. How am I going to buy $100 worth of stock? Well, the way I'm going to do that is I'm going to borrow $90. All right, so I'm going to put this in kind of parentheses. $90. Right. If this works, I'll buy a stylus and do better. All right, so I'm going to get it for $90. Well, that's cool. This is something that's done and no big deal. And what's happening in the year or two leading up to this crash is the stock market is going up and up. So now my stock is worth $200, right? $200. Now my stock is worth $400. Let's see, $400, right? It keeps going up. Now, if I'm making $400 and oh my God, look at this, now it's $500. Woohoo, having a little party, feeling good, going and buying a new car, even though I don't need one, buying a 4-slice toaster, even though I've got a 2-slice toaster, right? I'm going to go spend some of that money. Now, I still owe this $90, right? But if I pay back this $90 to the broker that loaned it to me, then my stock isn't going to go up as much, is it? Right? So it's like, well, I'm a gambling person. I'm going to just, I'll pay them back later. Right? When it goes just a little higher, I'll pay for it. Well, that's what thousands of buyers do. And I think it's an important point to remember that the stock market in the 1920s wasn't like the stock market today, where so many Americans today have their 401ks, right? Their retirement plans invested in the stock market. So when we have the stock market crash in 2008, and where it's volatile even today, it's going to affect more everyday Americans than it did in the 1920s, right? Most Americans, very few Americans had money in the stock market. Who did have money in the stock market were a lot of businesses. They would take their profits, and rather than investing in their own business, in new technology or whatever, they would invest it in the stock market because it was kind of a quick get rich quick scheme, where it kept going up and up and up, and it was it played upon itself, right? Because if I buy stock for $200 and then everybody else sees, oh, they got it for 200, but it's going up, I better buy some. And then it's all worth 300 and it's all worth 400. It's that supply demand thing. And if everybody believes it's going to keep going up, it'll keep going up, right? I do, unsolicited advice. If when you get a job, especially if you're young and in your 20s, get into the 401k, put as much money as you can stand in the retirement program, because it's pre-tax, right? So it doesn't hurt as much, and you'd be amazed how much it'll grow. So back to the past, right? So my stock has gone up to $500. Then starting in August of 1929, the stock market starts to decline. All these sick industries that are going on, agriculture, the railroads, steel, all these industries that have been slowly doing worse and worse throughout the decade of from the mid 1920s to the end of the decade. And the reality is the problems are worldwide, right? There's economic problems all in Europe as well, where you had all these opportunities for growth after World War I. Everything starts slowing down there too. And it's just, oh, what is going on? And this is such an artificial peak that people start to get nervous starting in August or so of 1929, and they start selling their stock. So my stock that was worth $500, okay, now it's going to be worth $400 again, or maybe $425, right? 420. Let's see, can I draw two? Oh yeah, right, 425, right? Oh my gosh, it's starting to drop. Well, I'm going to hang on for a little bit longer because I still, I owe that $90, but I'm going to hang on. And then it starts to pick up speed. All right, now it's worth $300. Hey, I better sell because I want to make my profit here, right? I want to make my profit and I still owe that $90. And so many people are in that same situation that they all start selling at the same time. And if everyone starts selling at the same time, then what happens? It goes back to that basic supply and demand principle. If supply is high, right, you've got all this stock and demand is low, everyone wants to sell, the price is going to keep dropping and dropping and dropping, right? Because if you've got to have someone to buy your stock, you've got to have someone willing to buy your stock. And by October of 1929, that disappears. There's nobody willing to do it because everybody's so far in debt, they've got to sell their stock. And what starts happening is these brokers who've loaned the money, right? The fellow who loaned me my $90 is watching my stock. He's watching it drop. And he says, hey, by the way, I'm going to call your loan, right? It can do that anytime somebody loans you money, they can call your note, right? Always read the paperwork, read the fine print. They can call your note. They could say, hey, that deal, you need to pay us back now. So people become in more and more of a panic. And you see this drop and drop and drop until by 1932, right, which is the nadir or the low point of the Great Depression, is the fall of 1932, stocks have dropped 90%. They've dropped 90 to being valued only 90%. So if my stock drops to being only worth $10 a share, even though I borrowed $90 a share, I still owe that $90. So this is going to be a huge part of this problem of this stock market crash. Is it exacerbates things. And because it was businesses that were investing in the stock market, now the businesses have lost money and the businesses are going to start to close and they're going to start to lay off people and they're going to start to have massive unemployment, right? I hope this makes sense. It's very crude and rudimentary, and your economics professors would probably laugh at me, but it's the basics, and it helps you, I hope, understand what on-margin buying is. And even today, you hear people talking about on-margin buying or margin buying. It was illegal for many years after the 1930s. It came back in the 2000s, and then we had another crash. So it's really a pretty bad idea all around. All right. So the stock market finally has its big collapse in October of 1929, and it's on the newspapers around the world, not just in New York, but everywhere. You see in this ad or newspaper, billions lost as the stocks crash. The Senate Farm Bloc starts for the battle for higher tariffs, right? So the agricultural industry, everybody's worried about that, right? And this is just an image of where the stock market was in 1929, right? So this is January of 1929, and it's pretty good. And these numbers, of course, our stock market today is so much higher. The numbers are exponentially higher than they were then. But you can see these numbers, and then very high, but it does go up to this peak in September, has a little crash and little recovery, and then just slams down. So by the end of, there's November, which is just a month later, you can see where the bottom is. And then it's just devastated by the end of the year, right? You can see it's huge losses, right? This is a broader look. So that one was how it dropped in just 1929. You have the fairly steady with some growth, and then this huge growth, and then this collapse. But this really shows 1929 through 1932, this is the end of 1932. Again, this is the low point of the Great Depression. And you can see here's where it had been, that little peak that we saw in that last chart there, that last graph, and then the crash in the fall of 1929. So this is the end of 1929 right here. It recovers a little bit, and then this just steady march to the very bottom. And again, it's 90% lower than those peaks, and 86% lower than where it had been kind of hanging out for the whole year before. So just huge losses of stocks. And again, these are going to be businesses that are counting on the stock prices to sustain them, and then businesses who had invested in them. And it's a huge collapse of the whole market. Right. Just another one. This is going to extend it out a little bit more so you can see where it goes throughout the entire decade. And again, you can see these stock prices in the 19 teens, 1920s. You see this kind of huge growth in the 1928, 1929. So this is kind of where it had sat. And then this huge drop again. Some recovery in the mid 1930s, and then as we come out of the Depression, but then we actually have a recession in the middle of the Depression. And then what we'll see here is a growth again in the 1940s as we hit the war years and the industrialization of the war years, right? So I'm going to stop with that slide, and then we will talk about unemployment and those other things as well. But hopefully that gives you a little bit of an idea of what the purpose of the stock market was, of how it worked, and how the crash actually happened. All right.